All right, so let's begin the show. The Security and Exchange Board of India has proposed sweeping changes to mutual funds total expense ratio TER, which accounts for the fees and expenses charged by asset management companies. Now, as per the SEBI proposal in the consultation paper, the total fee charged to a mutual fund investor or the expense ratio should be inclusive of all expenses, including brokerage paid by fund houses to purchase shares or other securities. Now, with new norms, these services will come under the ambit of TER and can cost AMCs almost 1,400 crore per year. Would that mean shrunk profits for asset management company and lesser fees for the distributor industry? How viable is this for the unit holders' perspective? Let's understand all of this in deep detail with D P Singh, Deputy MD SBI Mutual Fund. DP sir, good evening and welcome to the show. And SEBI is proposing uniform TER in an attempt to enhance transparency to the cost charged to the unit holders. Now, you must have seen the proposal. We all have. It's a 40-page proposal. How are you reading it? What is the sense that you are making out of it? You are India's largest AMC. Also, tell us from an investor's point of view, what do these proposals mean? And what is the existing pattern of what's been proposed? I've actually asked you a lot of questions in just one question. You can just break it down.
Yeah. No, thank you, Kavita. Thanks for having me. Honestly speaking, we are also going through the numbers. We are still trying to see how it will impact. Of course, SEBI has come out with its paper on the basis of some discussion they would have internally. They have definitely shared with the industry also. But there are views like this. This is somebody thinks in one way, and of course, this is a consultation paper. We are working on it. We'll respond to the consultation paper, and I'm sure, see all angles, looking at the all angles from this thing, from the investor point of view, from the industry point of view, from the intermediary point of view, and more than anything else, keeping in view the growth of the industry. I think the final whatever will come will be for the benefit of everybody. While saying so, I think there's a lot of growth capital which still this industry need because we are not yet scratched the surface. When we look in the percentage terms, of course, it looks like that we have grown very well. Of course, can't deny that we have grown very well, but the opportunity and the potential is much larger, and we need to reach out to many more nooks and corners of the country, for which the intermediation is required, and see a proper economically viable remuneration structure is definitely required for the growth of any industry. I think we'll be putting forward our views, and we'll see how it is impacting overall, and a rational decision will finally be there. I'm very sure about that.
So, looking at the current structure of these proposals made, DP sir, what could be an intermittent challenge for an AMC like you?
See, immediately there's as far as we are not capital intensive industry. We don't need much capital. That is very much there. Profitability less or more is a secondary point. But my point is not even I'm not looking at from the AMC's point of view. Mostly, what I am looking from the penetration point of view, the growth of industry point of view, and see what happens here. The structure which is being proposed, it's differentiating between the larger AMCs and smaller AMCs. That is something which we have to understand, because the responsibilities and accountabilities of the bigger AMCs are also different from the smaller AMCs, and smaller AMCs are doing a pretty good job in giving solutions to the industry. So it has to be in fact, if you look at the existing structure also, the larger the scheme size, lower is the expense ratio, which is already there. And during the last 5 years in 2018, the expense ratios, average expense ratios at the industry level has come down by 40 basis points. And we have schemes, the larger scheme, where the expense ratios have come down as high as 50 to 60 basis points also over the period of 5 years. So that system is very well inbuilt in the system. But going forward, what the structure is being proposed is at the overall AUM level. Of course, I think there are some different ways of looking at it, and we will put forward our point of view, and I'm sure that will be considered.
break down the current structure, DP sir. And when you say that, when SEBI says that TER must include brokerage expenses too, so far, what's the breakup? And were investors actually being made doubly charged? What could be the impact of this on the fund house if this proposal gets through?
So that's fine actually. That they have a reason to say that. And today when they allowed extra charges. So the point of SEBI is that it should be totally transparent, and I think there's nobody can deny that people should be aware that how much expenses are actually being charged. When we are showing something and actually charging little more, so there's no denial on the fact that when we are at the highest level of transparency, there should be nothing which is hidden. So that's absolutely fine. That can be taken care of. That's in any case, this 12 basis point which is being talked about is the maximum limit. And I can't say for everybody, I can't vouch for everybody, but I think majority of the fund houses average expenses which are being charged are 3 to 4 basis point or 5 basis point. That's it. So that's how it is being charged. And if that is being brought in the total expense ratio, that's fine.
How is SEBI asking the AMCs to use the investor education fund? What's being proposed on those lines?
You see, they're saying that the B30 incentive, which is being paid when we were charging extra to the scheme, rather than charging extra, it should be paid out of the investor education fund. Which, of course, when this started, we were charging 2 basis points. That time, industry was 8 lakh crores, and today industry is 40 lakh crores. And see, with the kind of the thing is coming to the new investors only. I think this one page should be good enough. And see that's not a big issue.
One very interesting proposal is performance-based TER. SEBI has proposed performance-based TER. How are you looking at it? It's a widely adopted concept in the West, but then do you think this can actually work? And if the fund is not performing, you don't need to pay that extra money to the fund manager. How are you looking at it?
So this is being proposed as one of the categories, right? So there's no issue. This is something between the normal active fund and PMS. PMS generally there is the performance fees, etc. And here, if you are talking about it, then see, this is something. One category is good enough. If there is one fund which is charging on the basis of the performance only, but only issue is when how it will be implemented, because in equity funds, I can't say that 1 year is the unit, because generally we advocate that this is if we are very bullish on a particular stock and we pick up in our portfolio, that stock may see the traction in the market during the first year itself, or it may take 1 or 2 years. So it's very difficult to put a unit, I mean, year as a unit or quarter as a unit, or 3 years as a unit. So that's something which we'll have to see. We'll respond to that, seek the guidance, and we'll see how it is to be implemented.
Now, in the implementation, the question is, when does an investor actually gets charged? Because a fund will have a cycle of performance, and there will be times when the fund can perform. There will be time when the fund must have underperformed. Any guidelines on those lines mentioned in the proposal?
Not really in the proposal. That's what I'm saying. We'll have to debate on that. We'll have to interact and understand what is how it is to be calculated.
Right.
That's a separate thing to be discussed. But I personally feel that this is consultation paper, and I'm very sure if we are able to put forward point with backed by the proper data and the condition. So as on date, I'm not very worried. And as an industry, we can handle this, but there are some concerns which we'll definitely tackle and discuss with the SEBI over the period of time.
Sir, just looking at the consultation paper, did you do any number crunching? Because this seems to, come as a shock for the industry of almost 1,400 crore. How do you see this impacting your AMC? Did you do some maths? Anything that you can talk about on those lines?
No, we are in the process of looking at it. And second, Kavita, since we are in the sunrise industry, so over the period of time, volumes will also make up for it. So we can't say on a particular day, and this when we are calculating, we can't say this is going to remain the business. Business will grow. In percentage terms, we may lose. but in the absolute terms, we may grow. I mean, see, these things have happened earlier also. But as I said, when I'm not looking at the number as of now because I feel a lot of things which we can discuss. And see, honestly speaking, SEBI is listening, SEBI is consulting, and they will definitely discuss, and they will get convinced, and they will convince. That's the point.
Right. Could you also explain the proposals made on the NFO collections?
I think that's the story of the past. And if you look at today, the NFOs in any case, most of the fund houses have exhausted all the categories. Maybe one or two more categories come, and moreover, the kind of regulations which are there on the distribution of fee, etc. I think these things are. I mean, we have seen the worst, and I think we are beyond that. Nothing, no abuse can be done as of now.
Mm-hmm. How do you see TER getting uniform for equity and debt? What's the TER now for equity and debt? If you could just tell us the breakup.
So today, the equity funds, every category of funds, there's a graded structure which is up to 500 crore rupees, a particular amount. And then as you keep on going, just to give you an example, one of the funds which we are having 7 years ago, and 5 years ago, when we had 2018, we were charging on that around 2.10% as the TER. And with the growth of size, today that fund is charging 1.35% because of the size going up. So it has already happened. And the benefit of that low charges have already been passed on to the investor. But going forward, we uniform the, I mean, if the overall structure comes down, there will be some funds, very big funds, where it can go move up. Because one good thing which has been done, because there's a GST issue also, which has not been discussed because they have increased the maximum from to 2.55 from the existing 2.25. So going by that in a graded manner, so something will be taken care of. And see, of course, whenever there's a hit, it has to be passed on partially to the distributors also. But my issue is the new distributors are not coming into the market. If they don't have a viable, economically viable the business point, then they will not enter. And mutual funds being B2B, where we have yet to reach even a percentage of what the advanced economies are, I think there will be an issue because growth capital will become scarce and it will be difficult to reach out to many more nooks and corners of the country. So that's something which may concern, but I'll have to see the numbers to really make up my mind on this.
SEBI is also giving a lot of thrust to, to curb mis-selling and to ensure there's transparency. Overall, looking at these proposals, do you think it's actually serving that kind of a purpose? And obviously, all stakeholders are needed in this particular thing. But then, do we really expect this particular sector to go more transparent, or you think that it'll just complicate it further?
I think we are very transparent enough. As far as mis-selling is concerned, there cannot be any two views. The mis-selling has to be dealt with very severely wherever it happens. And over the period of time, I will say that the distributor community, which is being charged with the mis-selling, over the period of time, a lot of discipline has come into being. So even they are behaving in a very responsible manner. And this is a evolving situation. And already the even for the mis-selling, the AMCs are taking all the actions. We have seen. See what happens sometimes. Distributors versus the investor also there are some issues which we come to know later on. So we have to see overall how the interest of investor is taken care of. And I think regulator, AMCs, everybody is having a simple single view that there can be zero tolerance on the mis-selling. We cannot afford to do that. But only advantage to the mutual fund industry is that everybody is putting money in a liquid asset. So one can withdraw at any point of time, but that's not a point that you should have mis-selling. But see the mis-selling and other instruments like insurance where the money is locked in has far-reaching consequences than the mutual fund mis-selling. But While saying so, I'm not at all suggesting that even if some mis-selling is there, it's acceptable. Not at all. It's zero tolerance. But yes, this is liquid and people don't get. If you look at the complaints, etc. Also, the mis-selling complaints in mutual fund business is much lower than other instruments.
Last question to you. The proposal also focuses on women investor education and women participation. How is it laid down there?
So very interesting vision which SEBI has come out, because this is one of the very progressive steps within from the investor education one. Only if new women investors are brought in, then there's an extra distribution cost which is to be given. I think we will welcome that, and we're very happy to do that in our businesses.
All right, I think that will be all. We all are waiting for the final print that will be approved, taking all the stakeholders under consideration. But then till then, thank you so much, DP sir, being on the show and helping our viewers with this today.
Thank you very much. Thank you very much.
On that note, we'll slip into a quick break, but then post that, let's talk about ICICI Pru Large and Mid Cap Fund. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, on The Money Show, we make sure that we just don't talk about investing in mutual fund, but also help you meet the brain behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Ihab Dalwai, Fund Manager, ICICI Prudential Mutual Fund. We'll be talking about ICICI Pru Large and Mid Cap Fund with him. Let's understand all the strategies that he's talking about today. Ihab, good evening and welcome to the show. Thank you so much for joining in. And we'll be focusing on your on ICICI Pru Large and Mid Cap Fund, a category that investors look for to get a sense of comfort, stability, low volatility and high appreciation. But before I get into the portfolio of your fund, I just want to understand the general sense of market that you have right now. You think the FII party that's just begun is going to stay longer? What's your take on that?
Hi, good evening. So what we've seen over the last couple of years is that FIs have been sellers in India, but that of late has reversed. There are a couple of things, reasons for this. One can be that expectations globally is that rate cycle globally as well is close to peak, and as a result of which EM and equities also end up looking attractively, especially EM equities. That's one reason why I think the flows have come back from an FI perspective. I feel large caps were the segment which was most impacted because of this, especially the mega cap names. With the flows coming back, I think that segment is expected to do well.
But then going forward, now if I have to talk about the major concern, which is maybe monsoon for us, because otherwise, do you also think after monsoon, the other concern will be a larger pause on the rate hike scenario, or you think that's already taken care of and right now we have a breather as far as rising interest rates are concerned?
So obviously, monsoon would be watched very closely, especially for the rural economy, and that segment of the market or that segment of the consumption is actually not has not actually picked up post the last festive season, that is September, October. So the expectation is that that segment is expected to pick up, but monsoon would be watched closely. But one point I would like to make is that irrigation has also picked up meaningfully over the last, I would say, so many years. The impact which we used to see of monsoons on crops, production, and prices, I think that has slightly come off. But obviously, it plays a key role in terms of demand, especially for the rural part of the economy. And as far as the rate pause, I think that is something which markets has taken in a positive sense, especially for the equities market, because mind you, inflation in India wasn't as high as what we had seen in the global economies, and if we had continued increasing rates, obviously the consumption part of the economy would have taken a bit of hit, especially the leveraged consumption, which is generally housing or auto consumption. So I think it is a prudent step, so that part of consumption is not hurt.
Ihab, what sense do you drive looking at the quarter results that have come up? And do you think the market is now going to be a very stock specific market for maybe the last 6 months of this calendar year?
Yes. So, if I dissect the market on sector basis, like banking obviously has had a good set of numbers. Obviously, we've had good credit growth. We've had record low credit cost. NIM expansion on back of rising rates has also helped the banking segment. So we've got good results from the banking space. Then, if I look at IT as a space, given the narrative or the talk of global slowdown or US slowdown, IT results were a bit of stock specific on a sector wide basis. Expectations had obviously come off before the results, so they've not disappointed on the lower expectations. But there are certain stock specific issues which had crept up in IT as a space. Apart from that, if I look at pharma, what some sense what we're getting is that US pricing has improved on a quarter on quarter basis, and domestic businesses have got into a reset mode because of the NLEM pricing, but we expect growth to pick up over the next 1 year. So that's broadly how and autos as well. Autos, we've seen a bit of recovery in autos as well, but going ahead, confidence of two-wheelers doing well is high. And on capital goods, we've seen good order inflows across space, which has helped the capital goods space as well. And like I mentioned, real estate has also been doing well, which has been visible in the sales number which the real estate companies given out.
All right, Ihab, now let's move on and let's talk about the large and mid cap fund that your AMC has. And talking about a large and mid cap category, you have an option to invest in almost 250 companies in terms of market capitalization. Just for a basic understanding of our investors, what's the capping and exposure when it comes to large cap and mid cap stocks?
So, yeah, just to give a bit of a history or background to this category is that this category came into existence especially after the scheme categorization which SEBI had imposed on the mutual fund space. So this category had come up, and what the definition says that the first top 100 stocks are the large cap stocks, and then from the 101st to 250th stock is the mid cap space. And AMFI is required to come out with a list every 6 months, and this is based on the full market capitalization. It's not based on free float, so it's on full capitalization that AMFI comes out on an average basis, which are the top 100 stocks and which are the next 150 stocks, which forms the mid cap space. So from a portfolio allocation perspective, currently, like I had mentioned earlier as well, that my and our team's preference is towards large cap currently. So from a portfolio allocation, the fund is leaning towards large cap. So it has a higher allocation to large cap. It would have around 55% would be the allocation to large cap. And on the mid cap side, it is somewhere between 35 to 37% would be the mid cap allocation. So the mandate requires us to have minimum 35% in both large and mid cap. So as the preference is currently towards large cap, so we have a higher allocation to large cap.
So you are one of the best performers when it comes to this particular category, and if your focus is on large cap, which means you are looking at stability, and mid cap obviously is utilized for when they have higher growth potential. But what exactly and what pockets are you looking specifically in mid caps? I have the sector allocation data also, but then if I want to know specifically about mid cap, what sectors are you looking at, and in terms of valuations, you think they are right?
See, mid cap as an index generally is currently at a slightly higher valuation, but that is justified, or market justifies it through the higher growth rate expectation out of the mid cap space. So if you look at the mid cap as a space, so there are certain sectors or segments in the market which aren't present in the large cap space. So the leader of any sector is a mid cap itself. So to give an example, auto ancillary space is an example where the large auto ancillaries itself are mid caps. Secondly, I feel that there are certain so generally in a sector, if a company wants to be a large cap, it ends up over diversifying, and it is present in most of the segments which the sector can be present in. But if you want to buy a company which specializes in a particular segment for that sector, we would have to go in the mid cap space. So, for example, like within lending space, so if you want to go into a specialized lender, like if you want to buy a gold financer, if you want to buy a housing finance company, if you want to buy a vehicle financing company, these aren't large cap companies. These are mid cap companies, and that's why if you are positive on a sub segment of a particular sector, you can build weightages in the mid cap space, and that's how that's how I approach the mid cap space. I try to find out sectors or segments which I'm positive on, but one has to keep in mind that mid cap generally are trading at a slightly higher valuation to the large cap peers. But within the entire space, there are pockets which are available at reasonable valuation as well.
What about large caps? Now, I have the sector allocation, but then what kind of companies are you interested now?
So from a sector perspective, like I mentioned, we are positive on autos as a space. So allocation to auto OEMs would be high, and also to auto ancillaries, but that comes under the mid cap space. Apart from that, preference continues to be to private banks, large private banks. So like I mentioned earlier, though the operating numbers have been good, the expectation going ahead is not that credit cost or credit cycle is going to go up again, or the credit growth is going to come off. So if this low credit cost environment sustains, or if double-digit credit growth sustains, I think the valuations in the private bank space is not reflecting this sustainable delivery of earnings or operating numbers of private banks. So that is something which I feel there's a potential for them to re-rate a bit. So private banks, autos, and pharma as a space is something which I like, and I like mid-cap pharma names, because mid-cap pharmas represents, like I mentioned, the large-cap pharmas are diversified. They're present in India, they're present in rest of the world, they're present in US in a large manner. But if you build position or a portfolio of mid-cap pharma names, you can build companies which specialize or have a niche in a particular segment and are more domestic focused. I think domestic pharma is a space which has derated a bit, but gives a potential of has a potential of decent growth over the next 1 year, and are good ROE or return businesses.
You're giving inflation beating returns. I really want to understand, talking about a large and mid cap category, what's the risk diversification for an investor?
See, risk diversification for an investor is that the universe for the fund is not only the top 250 stocks, but the fund can also invest in go beyond that 250 stocks, but can invest to a smaller portion to that. So the universe is quite wide. The investor is not concentrating his capital in a very narrow segment of the market, because, like I mentioned, it's a quite diversified universe where the fund can invest in. And like I mentioned, that 70% of the portfolio has to always be invested in stocks which are within the top 250 stocks. So from a liquidity perspective, also the investor should not worry that is he invested in an illiquid portfolio, which, if in case his market view turns negative, can he will the prices come off, or will that impact the portfolio? So it's quite a liquid portfolio, a diversified portfolio. So I think the risk of investing in this fund is on the lower side, is what I would say, because of the diversification of the portfolio.
Will be all. Thank you so much for being on the show and helping our viewers with all the nitty-gritties of the fund. And on that note, we'll take a quick break. Post that, let's get our viewers connected, and let's help them with their financial portfolio. I'll be joined by Feroz Aziz after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio? What are the criteria and what should one look at before deciding a fund? To help you navigate through this maze, we have on board today Feroz Aziz, Deputy C1 and Rati Private Wealth. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Good evening, Feroz, and welcome to the show. And first question I will be taking is of Sanjita. Is Sanjita there with me on the phone line? All right, I don't think we have, but then we are trying to get in touch with her. But she's sent her question. She's 28 years old and she already is investing in Parag Parikh Flexi Cap, PGI Mid Cap, and Axis Small Cap. She wants to diversify into a debt category also for liquidity specifically. If I have her on the phone line, we can ask her more questions. But then so far, what will be your suggestion? I think you're on mute. Feroz, you're on mute.
Good evening, Kavita.
Hi.
I think Sangeeta has done one right thing, which is to have three different schemes from three different categories. One is large cap heavy, that's Parag Parikh Flexi Cap. Then she has a mid cap scheme, which is PGIM, and then she has a small cap scheme. So the thought process in terms of the direction of allocating money across different market segments seems very correct. Second, I'm sure there is some degree of modification needed on the scheme selection. Coming on the debt side, if liquidity is paramount and this is not like long-term debt investing, then I would currently, in the current circumstance, prefer an arbitrage fund, which gives you a taxation of equity, but behaves like debt. I think in the current circumstance, the arbitrage funds are almost giving you 5.5–6%. Since the taxation is just about 15% on the short term, the post-tax returns supersede the liquid fund returns reasonably for a person in the highest tax brackets. That's what she should choose. In the arbitrage fund category, she can choose a Kotak arbitrage fund, which I think is one of the largest funds. And I think that should deliver about 5.5–6%. And post-tax, even for a couple of months of investment, she can get above 5%, which I think is very attractive.
All right. What will be the tax treatment on this debt category fund, Feroz?
The tax treatment is like equity. So if you redeem the money before 1 year, which is short-term capital gain, and that's 15%, and there's a marginal STT on it. So 15% taxation. But if you invest in a liquid fund, then it adds to your marginal tax rate straight away. If you're in the highest tax bracket, you might end up paying even 39%. But arbitrage funds can allow you to get a capital gain in the short-term capital gain head, which is at 15%.
All right, we move on and we have our next caller on the phone line, Captain R.R. Reddy. Good evening, Captain. Thank you so much for sending us your question. How are you doing today?
Fine.
I think you have a question on NPS, Tier 2 account?
Yeah, that is it, yes.
All right, and you want to know what will be the tax applied on this particular account?
Correct.
If you withdraw the money. All right. Thank you so much for sending us this question. And Feroz, before we get into the nitty-gritties on Tier 2 account, could you also explain and elaborate maybe on the two types of account, which is Tier 1 and Tier 2, that you get to invest in as per NPS?
Yes, so Tier 1 is the more lock-in kind of account where you do a compulsory or a compulsory lock-in till retirement, and at the retirement you have 2/3 of it which can be paid to you. 1/3 has to get into an annuity. That's a very restrictive step because it also gives you the tax benefit under section 80CCD. So that's point one. Point two, Tier 2 capital is more flexible. It's more like buying and selling. You can do that with hardly any restrictions. So Tier 2 is going to give you a tax implication of just like an equity mutual fund, which is short-term capital gain at 15%, and the long-term capital gain will be taxed at 10%. And for that to bridge the gap of short-term and get into long-term, you will have to wait for 366 days.
Feroz, what I also want to understand is a Tier 1 account is a mandatory account. When you want to invest in NPS, Tier 1 is something that automatically you get an option that you can start your investment with. Tier 2, is it important or mandatory or relevant to even have a Tier 2 account?
Yes, see, Tier 2 account is not mandatory, but it's a very relevant one because you get the same fund managers at 100 the cost. So if you're very cost sensitive, you can get most of the top fund managers in the country at a 0.02, 0.03 paisa expense. So that's point one. Point two is it can definitely give you the flexibility to buy and sell. One thing which is very important, Kavita, I should mention, is the gains you make from the debt component of the NPS. It's taxed as marginal tax rate and adds to your income straight away. So to answer your point question, yes, tier 2 is a very attractive one because you don't give away the liquidity. If you can, if you're not locked in, then your generosity with respect to your SIPs in that or your contributions could be significantly large because you're not hesitating. Because when you want to take a U-turn, you have the flexibility to do so.
So when we talk about having an active choice or an auto choice as per NPS, are all these features applied to a tier 2 account also, or you can just invest in whatever schemes you want to?
No, there is, you have to make a choice in terms of your fund manager. You can change that every year. And you can also change the allocation between equity and debt or at a frequency.
Okay, and the same rule applies for tier 2 also. Post 60, you get 60% of your corpus tax free, and then later on you need to buy an annuity of the rest 40%.
No, tier 2 you can withdraw your money at any point in time without this restriction.
All right, we move on, and we have Tony's question, and he's from Dubai. He says that current portfolio has SIP in Parag Parikh Flexi Cap, UTI Nifty Next 50, Quant Infra, PGM Small Cap. His time horizon is to invest for 15 to 30 years, and he wants to understand if the asset allocation is right for him, and he also wants to increase the SIP amount by around 10,000, and he wants to add a mid-cap fund, and for that he needs a recommendation.
So Tony, firstly, when you do an asset allocation, the most important thing is they should be all assets. Quite a few people, without incorporating all what they have, other than the house they live in, is the only purpose of that is growth. If you have a holiday home, then you have a purpose of utility. That's not a part of your wealth. Wealth is every dime which you have, which you're not using or do not have any other purpose other than the growth of its value. So first, define every rupee you have. Even a hand loan needs to be counted, a PPF, EPF, your insurance policies, which are non-term policies, all of those, count them. And then you can actually arrive at an asset allocation. That's point one. Point two, your 4 schemes, I think 2 of them I would definitely ask you to consider an exit. Quant Infrastructure Fund. Quant is a good AMC, but infrastructure, why would you want to incorporate a theme into your portfolio in the beginning years of your investing? And I really think that fund managers, if they like a theme, anyways in the diversified category, they skew. Like in 2008, this is what happened. In 2007, everybody was buying an infrastructure theme-based fund, and the funds managers of diversified equity funds were also skewing it towards infrastructure. So I've seen several portfolios which had 60-70% of their portfolio in infrastructure costs, in infrastructure stocks before the market crash, and that created huge amount of bloodbath. So let's not repeat that mistake and take thematic schemes when fund managers themselves can also skew it. So those are the 2 ones. I don't like index funds because I personally think 380 active funds, if you look at Kavita's shows and choose active funds a little more wisely, beating Nifty is not such an uphill task across 8 different categories if there are schemes available. Now let me read out some schemes to you which you can use for your new SIPs and the ones which you currently have and which you may so chose to stop. HDFC Flexi Cap, ICICI Proof Focused Equity, SBI Contra, SBI Large Cap, Franklin India Blue Chip, HDFC Small Cap. I think these are 6 schemes which you can definitely consider adding to your portfolio and make it a little more elaborate portfolio of 7-8 funds to make sure that your SIPs are reasonably diversified.
All right, we move on to our next question, which is from Kiran, and Kiran wishes to invest almost 10,000 from his savings to equity mutual fund for a time horizon of 10 years, and is looking at a combination of he wants to avoid the risk of volatility of mid and small cap companies, and which is why he finds it safer with the large cap category, Canara Bank blue chip equity, and is what is he looking at for his first investment. And he also wants to know one more large cap fund.
So, firstly, I think Kiran, the thought process of saying that small and mid caps are going to be very volatile and very risky it's not so intimidating to buy this category if you're buying it through a mutual fund, because you have two layers of safety, and risk is something which I'll allude to with respect to the numbers which it throws up. Firstly, don't be so afraid of small and mid cap, because that's where the growth comes. If I look at the next 1 year's earnings growth, which we were just computing a couple of days back, small caps have an earning potential of 30% for the next year, and large caps have also 18 odd percent, and mid caps about 25%. So if you are a long-term investor, small caps will not destroy value if you stay the course for long periods of time. And small cap itself has gone through an evolution itself, right? Last 5 years back, a small cap company, the biggest small cap company was 8,000 crores market cap. Today, the biggest small cap company is 16,000 crore market cap. The name still remains small cap for the last 5 years, but the size has doubled. The number of companies which are greater than 3,000 crore market cap in the small cap category is 396. 5 years back, there were just about 225. So the universe has expanded. The size has expanded. They're still called small cap. If you numerically measure the value of the risk in the form of beta on a 3-year rolling basis, the betas are almost as much as Nifty is. On a daily realized standard deviation or the risk, it's a little more, but a 3-year holding period, the small caps risk converge with Nifty. That's a revelation itself from a mathematics standpoint. So I think if you want to, you're investing in an SIP, firstly, staggering it. If you're investing in a mutual fund, and then don't shy away from the most logical risk to take. So I will give you some small cap funds if you, in case you change your mind ever. So mid cap category, definitely. Let me give you Kotak Emerging Equities, the Pankaj Tibrewal scheme. You can look at on the small cap category, HDFC small cap, Chirag Setalwad, and Aditya Birla small cap. So these are some schemes which you can consider. And don't be so intimidated with the small cap risk, especially when you're investing in a mutual fund which has 70, 80 stocks, and you're investing in the form of a staggered fashion on a monthly basis.
All right, with that, we move on. Vishwas Kulkarni's question, Feroz, and he wants to know how is ICICI Pru S&P BSC Sensex Index Fund. He's looking at investing 12,000 per month for the purpose of retirement, and currently he's 31 years old.
If you're 31, Vishwas, to my mind, just buying a Sensex fund is not a great idea. See, like if you, of course, active funds can also underperform Sensex, nothing to say that. But if there are 380 funds, if you have a microscopic lens, identifying those 40-50% who are going to beat the Sensex is not such an uphill task. So that's point one. So don't put all your money in Sensex. That's not a prudent strategy. You will miss out on a lot of India growth story, which is represented in the form of small cap and mid cap stocks as well. So let me give you some active funds beyond what you have chosen for yourself, which is the Sensex fund, which is only 30 stocks. So HDFC Flexi Cap can give you a lot of exposure both on the large and the mid and small cap space. You can add ICICI Focused Equity, which has only about 25, 26 stocks in the portfolio. SBI Contra, which gives you a contrarian approach. So you will have more schemes that will become complementary constituents rather than competing constituents to build a portfolio.
So Feroz, now I don't know if Vishwas is a new investor or a first-time investor, but then the fact that he wants to start investing with an index fund right now, you've given him the plan to later diversify, or maybe he should approach that first. Typically, for someone who is not aware of the market, is not well-read, an index is a safe play for them?
See, Kavita, I think mutual fund itself by design doesn't have its investors to be really well read. Because there's a fund manager, right? So if you're not well read, the other answer could be just go with an index fund, and every professional who's giving you the service of managing the portfolio can't be useless. So you have to find the people who are good. So to answer your pointed question, Kavita, even if you're a beginner, don't start with a small cap scheme, but there are actively managed great schemes. Like if you look at the Prashant Jain scheme, which Prashant left behind for Roshi Jain to manage in September 2021, has added immense value over the last 2 years, 14% alpha on Nifty. So how can somebody say that none of them can generate alpha? So having about 30, 40, 50% in a Sensex index fund is okay. 100% is not a great strategy, is the point being made for Vishwas. And I strongly believe that he'll be able to get a little more value than Sensex for sure, post the cost. Because cost is really minuscule. Now, if you look at the last 5 years, Kavita, you'll be shocked. The best equity scheme was Quant Small Cap with a compounded return of 38%. And the worst one compounded for the last 5 years was ABSL Pure Value, which was 4%. if the difference between the best and the worst is 34% compounded per annum, painting them all under the same brush may be a little unfair. So that's why even if he's a new investor, he can have some very well-tested 25-year-old funds of prominent fund managers.
All right, with that, thank you so much, Feroz, for being on the show and helping our viewers with their financial portfolio today. And we move on. Now we know the government's decision to hike TCS on international rate card spends has raised a lot of questions in your mind. How will it impact you financially and how will you be taxed and so on? On the Money Show, we will answer all of these questions in exclusive discussion tomorrow. So do send us your queries on our WhatsApp number, which is 865-797-4571. You can also email us your questions on themoneyshow@etnow.tv. And with that, it's a wrap. Thank you so much for watching today. Goodbye.